Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Interpipeline stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Interpipeline is an oil, natural gas, and petrochemical transportation and infrastructure company. The company is headquartered in Calgary, Alberta, Canada, and was founded in 1997. It started trading in 98 and can be found on the TSX, Pink Sheets, and Deutsche Börse. It is the biggest transporter of oil sands bitumen, with over 1 million barrels a day. Bitumen is asphalt. Brookfield Infrastructure Partners offered to acquire IPL for $16 a share, but IPL declined the hostile takeover. Brookfield upped its offer to $20 a share, plus a quarter share of Brookfield stock, but IPL still declined. Pembina is offering the equivalent of $19.45 for a share of IPL, and it seems that IPL will accept the offer. IPL feels it will have better synergies with Pembina than Brookfield. If the deal with Pembina goes through, then IPL will own 28% of the combined company, and Pembina will own the remaining 72%. Once the Heartland project is up and running, the combined company will generate $1.1 to $1.4 billion of operating cash flow. There will be a meeting on 7/29 for final approval by the shareholders, subject to regulatory approval, of course. There is something IPL does not like about Brookfield they're not telling us, because most of the time, the higher offer wins. But the higher offer is not winning this time. Let me just give you an example of why a company may not take an offer from another company. Imagine someone you hated and you could not stand being around. If they wanted to buy half your company, you would probably decline the offer even if it was 10% more than the second offer, because you don't want to deal with the stress and anxiety of being around that person. Money is not always the number one factor. I'm not implying that this is the situation with IPL. I'm just giving you a scenario where you may turn down the best offer. With this merger, Pembina will leverage its wind and cogeneration segment in order to grow its hydrogen, carbon, and LNG segments. The company sees significant synergies by coming together. Right away, the combined entity will lower admin and operating costs by $100 to $150 million. Another $50 million in savings in year 2 from commercial and product optimization. There will likely be more efficiencies in the future from the combo of Pembina and IPL, such as higher capacity utilization. The Heartland Petrochemical Complex is the big money grab for the combined entity. It will give them $5.2 billion of revenue. It is an integrated propane, dehydrogenation, and polypropylene complex. This will produce fully recyclable plastic. The design supports world-class sustainability initiatives, minimization of GHG emissions, and reduced water use. The project should be completed by the end of this year. It already has 85% of contracts in place, which gives them stable cash flow for years to come. Polypropylene has been rising in price while propane has been decreasing. This simple fact makes this particular project even more lucrative. The complex should begin operations in early 2022. Let's get started with the model. This is a mid-cap company, 8.8 billion market cap. They're trading at $20 a share and they have 429 million shares outstanding. We're looking at the ticker that trades on the TSX, so all the numbers in this video are in Canadian dollars. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they had positive free cash flow in 2018, negative after that. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's pretty consistent and positive each year. Revenue is a sales for the company, and that's also pretty consistent year to year. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Cost of labor is a big cost of revenue for this company. Revenue minus cost of revenue gives you your gross profit, and that peaked in 2018 at 1.6 billion. It's currently 1.4 billion. Below that is operating expenses. Depreciation is a big operating expense for them. Gross profit minus operating expenses give you your operating income. And that is positive each year, which is good. But it was almost 1 billion in 2018. It's down to 600 million in the trailing 12 months. They have about $160 million of interest on their debt. And the bottom line of the income statement is their net income, which is positive every year. So their income statement looks pretty good. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they do generate a lot of operating cash flow. It is coming down. It was over $1 billion in 2018. It's about $800 million in the trailing 12 months. But still, they do generate a good amount of cash. But they're investing so much money back into their business. They had $1.6 billion of capex in 2019, $1.1 billion in 2020, and almost $1 billion in 2018. So they have negative free cash flow almost every year, except in 2018. So if a company has negative free cash flow, it's not a bad thing if they're investing back into their business. But if a company has negative free cash flow and negative operating cash flow, that's a bad thing. Unless, of course, they're a startup and growing their company. But if it's a mature company, having negative operating cash flow is a big red flag. Of course, investing back into your business is a good thing. You just have to make sure the investment pays off. If you invest $1 billion into a project, and that project only returns $800 million of cash flow, then you lost money for your investors. You would have been better off just letting the money sit in cash. As long as the investment in the project is greater than your weighted average cost of capital, you're adding value to your investors. If it's less than the weighted average cost of capital, or negative, then you're decreasing value from your investors. They added $200 million of stock in 2018 and $160 million of debt in 2020. So even though they have big negative free cash flow, they must have had a lot of cash on their balance sheet from prior years. Let's look at the capital structure. $4 billion of equity, $7 billion of debt. They're 38% equity, 62% debt. And their weighted average cost of capital is 9.6%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $12 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $8.8 billion. We divide that by 429 million shares. And we get a calculated stock price of $20.43. There wasn't much of a point in trying to value this company because the market already did. The fact that they received 2 offers, so they're trading at a price that's pretty close to what the other companies are going to buy them for. So there's really no guesswork on how much this company's worth. This is the price they're worth. Because if you list your house for $500,000 and nobody pays $500,000, you eventually get an offer for $400,000, your house is worth $400,000. Even if you think it's worth $500,000, it doesn't matter. The price is equal to what someone's willing to pay. So someone is willing to pay $20 a share. So I'm just showing you what their free cash flows would need to be over the next 4 years to justify a $20 stock price. So do you think they could generate $848 million of free cash flow by 2024? The HPC project alone is supposed to generate $400 million to $450 million of cash flow. Plus they have other projects. So maybe the stock is worth $20. I did a video of this company about a year ago and I said the stock was worth about $14. Simply Wall Street thinks the stock is worth $24 a share, so they're saying the stock is even better than $20. 8 analysts priced the stock that trades on the pink sheets. It's trading on the pink sheets around $16 a share. So the average analyst does say the stock is worth $20 a share. 20 Canadian dollars. This $16 is US dollars. This is where the stock has been trading since 2003. In 2013, it peaked at about $35 a share. It did come down a lot last March during the COVID crash. It has come up a lot since then, but it's still trading below its pre-COVID numbers. This is where the stock has been trading the last 12 months. So you can see for several months, it was pretty flat. It was up and down a little bit, but in a pretty tight range. Then when they got their first offer from Brookfield, the stock shot up. Then when they got their second offer, the stock shot up again. So nothing happened fundamentally with the company for the stock price to go up so much, except another company saying, I'm going to buy them for that much money. It's the same thing if you have a job and you're making $50,000 a year, so that company feels you're worth $50,000. But if you want to make more money, you can't do it by staying at the same company. You have to look for another job and say that new company is willing to pay you $70,000. Suddenly, your value went from $50,000 to $70,000. But you're the same exact person. It's not like your skills drastically increased when you went from $50,000 to $70,000. It's just that somebody made an arbitrary decision that you're worth $70,000 while the other company made an arbitrary decision that you were worth $50,000. Same thing with the stock. If someone is willing to buy them for a certain amount, suddenly the stock is worth a lot more. And this company pays a monthly dividend. They were paying 14 cents a share, but when COVID came, they cut it to 4 cents to conserve cash. They pay a 2.35% dividend yield, and they pay out 52% of their net income. Their industry pays a pretty high dividend. The average is 4.5%. But they're lower than the average in the industry. They have a pretty high beta, 2.32, so the stock moves more than 2 times the market. It's pretty volatile. The stock has done much better than the S&P 500, up 64%. And the 52-week low was $11, the high was $21. And obviously the stock is trading above its 50-day and 200-day moving average. About 1.5 million shares are traded each day on this stock. Of the 429 million shares outstanding, 386 million are on float. When a share is on float, that means it's available for the investing public like me and you to purchase. 18% of the shares are held by institutions and 4.5% of the shares are shorted. This stock is up a lot more than its industry and the market in the past year. In the past 3 years and 5 years, this stock hasn't done so well, but it's done a lot better than its industry. Because midstream companies are so dependent on the price of oil. If the price of oil is up a lot, then midstream companies make a lot of money and their stock price goes up. If the price of oil is down a lot, then midstream companies don't make a lot of money or lose money and their stock price goes down. When your business is directly tied to a commodity like oil, you're at the mercy of the price of oil. Analysts are forecasting their earnings to grow 8% and their revenue to grow 3%, which is much worse than its industry and the market. In the past 5 years, their annual earnings have struggled, down 2%, while its industry is up. In the past year, their earnings are down a lot, 25%. The industry is even worse, down 34%, due to the low price of oil. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be at $16,000 today. That's a 5% annual return. If you're looking to acquire a company, one way to do it is to go to the company and come to an agreement. If the target company doesn't agree to your offer, you may do a hostile takeover, which is what Brookfield is trying to do. One way to do a hostile takeover is to buy up at least 50% of the stock in the market. So Brookfield has bought up 20% of the company's stock. So far, IPL has defended the hostile takeover. And there are multiple ways to defend a hostile takeover. Maybe I'll do a video about that, or we can talk about it in the comments. The next biggest shareholder is Capital Research, then Vanguard, then BlackRock. Let's look at their financial ratios. Their price multiples are decent. They have a PE of 22, which is a little better than the market median. The way you calculate the PE ratio, it's market cap over net income. That implies investors are paying $22 for $1 of net income. Their price to sales is 3.5, and their price to book is 2.1. They do have $400 million of intangible assets. If a company has a lot of intangible assets, that's a good way to inflate your price to book ratio. Intangible assets aren't worth much. They do increase your assets, but you can't really sell them. Their return on invested capital is 4.4%. That's on the lower side. They can cover their interest payments almost 4 times with their EBIT. They have a pretty good ROE at 9.3%, better than the market median. They have a really low current ratio. They can only cover 30% of their current liabilities with their current assets. So they do appear undercapitalized. If they don't get acquired, they're definitely going to need some debt to fund their operations over the next 12 months. Because they had negative $300 million of free cash flow, negative $1.3 billion of working capital, and they have to pay out $200 million in dividend payments. So they're short about $1.8 billion. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 45 midstream companies, and the average for those 45 companies is right here. And IPL is worse than average in PE and price of sales. They are average in price to book, much worse than average in current ratio, below average in ROE. They're average in debt and market cap, and of course they're lower than average in dividend yield. So to summarize, they are bringing in a decent amount of revenue, $2.5 billion a year. Even though they have negative free cash flow, they are doing a good job at trying to grow their business because they already have 2 companies that want to acquire them. It's a very common exit strategy to get acquired because a lot of companies have a hard time growing, especially when they're against multi-billion dollar companies. They just don't have the resources. So the best way is to get acquired by a bigger company and then cash out and start a new project, or possibly stay with the company as an executive. I sometimes try to invest in stocks that I think will get acquired because generally when a stock gets acquired, the value of the stock goes up 50% overnight. So that's a great return. Of course, there is a risk that the projects they're investing in don't turn profitable, but they don't have to worry about that risk if they get acquired. The new company would have to deal with that. So when one company acquires another, the target company is the big beneficiary. The acquiring company usually has to go into debt to acquire the target company and is not always the beneficiary. They are a lot of times, but sometimes it doesn't work out. In this case, only time will tell. I rank their free cash flows 2 out of 10, their revenue 6 out of 10, and their ratio is 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.